Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more content like this, please visit the resource library on adisa.org. I'm your host today, Greg Mausz, and I'm joined by Woody Soemantoro, Executive Vice President of Due Diligence at MDS. Thank you for being here.
Greg, thank you for having me here today.
So this is a podcast-only edition, and we're recording here at the ADISA meeting, and we're talking natural gas today. First off, where is the market today, and what are kind of the short and long-term drivers of pricing right now?
Well, the natural gas markets today have kind of reverted back to their mean. When I say that is pricing from a standpoint of, if you think of COVID and the years just after COVID, we hit a spike of about $6 to $9 per MCF of natural gas. We've reverted back to the mean of pricing probably about $1.50 to maybe $2.50 per MCF for natural gas. So these are the levels that we saw back in, say, 2014 and 16, and then we saw it again probably around 2019 and 2020. So as an industry, we've seen this pricing before, and this is more of the norm cycle that we're in right now.
Which is good. That makes sense. And most everything regresses to the mean. So short-term and long-term demand drivers. Talk us through those.
Well, let's just start with the short term. Short term is almost always based on Mother Nature. I mean, we can't control that. It's ironic that, we watch the weather, the weatherman. We watch the weather just as much as an energy company out there. Because if we have very cold winters, there's going to be a high demand for burning natural gas for heating. Now we're starting to see additional power generation. So if we have really hot summers, we're starting to see more power burn from natural gas from the demands, the needs of air conditioning, power generation. So it's really interesting. The weather really does play such a large role. If we have a mild winter or a mild summer, that means we're not drawing from as much of the natural gas that we're producing and we're storing underground in these reserves. So as we see the reserves of natural gas as a country build, we start to see this kind of a low pricing in natural gas.
And all of that's cyclical.
Right.
It's going to vary from year to year.
Right.
Because there's no controlling Mother Nature.
Right. And then, the long-term side of that is, right now the United States is a swing producer for natural gas. We've never really been in that position. And we're in a position right now that by the end of the decade, we should start seeing a doubling of our export capacity of LNG natural gas. And this is something that we saw back in 2016 when we had the very first round of LNG exportation capacity come online. So, long term, we're looking at being able to export twice as much natural gas as we're producing today. So as producers, as an industry, we're gearing up for that. We can never time it properly or exactly.
Okay, Woody, that's a great summary of some long and short-term drivers, but let's talk about natural gas globally.
Sure. Natural gas globally, we're seeing a demand for natural gas in Asia as well as in Europe. With Russia being removed from the equation as a bad actor, the United States can fulfill that swing producer status, much like OPEC has done for oil in the past. We really are the OPEC of natural gas, the United States is as a group, as producers. So there's certainly going to be demand for our liquefied natural gas, and we're going to start to see our ability to export that liquefied natural gas abroad here, probably beginning as soon as 2025, and by the end of the decade, we're going to see the capacity for us as a industry and a nation to double our export capacity of natural gas here by 2030. And that's exciting. We should see prices rebound. We should start seeing our gas in other markets, and that is really exciting.
So are we on a current train to meet that 2030 goal, or is there kind of political forces that could derail that or speed it up?
So that's a really good question on the political nature. Right now the current administration has recommended a pause on any new LNG exportation facilities. What that affects are any new projects in the works. It doesn't affect any projects that are in the works. So even if they have this pause, it's not going to affect our doubling in capacity here by 2030. And so, on the rhetoric side, I think it just looks good because everyone wants to it's an election year, right? So I think both candidates are going to pander to their bases, whatever sounds good. But in practice, it's not going to affect what was already planned to come online between now and 2030.
Great. That's helpful to know. Thank you for kind of unpacking that statement, because when you see the headlines, it's hard to understand what's really behind all that meaning. So since we're talking about the administration, how is that affecting natural gas prices these days?
Well, the government can and cannot affect pricing, right? I think there's the biggest factor for pricing is the weather. It's that short-term intermediate demand. There's a joke, there's an old saying that you and I were talking about, that if you try to trade natural gas as a trader or a speculator, the commodity itself, it's so volatile, it's called the widowmaker. It will literally crush you, it'll kill you. But as a producer, we're out there producing natural gas. We're going out and developing this asset for sale in the future. We can never time it perfectly with what any administration wants to do. From our boots in the ground level, we're going to develop, I won't say as much, but there's some capital constraints that some of these public companies learned before, that they were just trying to drill, baby, drill, and expansion. And then probably post-COVID or so, these public companies kind of adopted the mantra that we did as a private company. We're trying to return money to shareholders. For us, it's investors. They did the same thing. Capital constraints. They live within their budgets. And so you're seeing that probably a greater effect on commodity pricing. So it's less of the government. The government can go out and say, hey, we're going to ban this, or we're going to limit the amount of permits, which we saw during this last administration. But that was so well telegraphed within the industry that any company that was going to be affected if you're drilling on public lands, things like that. And so it depends, right? It depends. And if you have any, say, government entity raising or lowering the barriers of entry, that can also have an effect. But I can go on for an hour about that, so we don't have that much time.
Thank you for that perspective. And while we're talking about forces that are affecting natural gas production, natural gas prices, let's talk about ESG, the environmental, the social, the governance, and the trends around ESG, and how that's affecting the natural gas industry and investors.
Yeah, it's a great question. I think as an industry, we're trying to get there, but no one will ever be at carbon zero. Depending on how you are structured as an operating company, and depending on which basins you're operating, you're going to try to use every possible advantage. One example would be, I think most operators in the industry are moving towards dual fuels, where I can run off of natural gas or diesel fuel. Well, diesel is more expensive than natural gas. Diesel also creates a carbon footprint. So by sheer economics, when we look at the E in ESG, we tend to look at that as that's economic efficiency. And so if I switch from diesel to natural gas, well then my carbon footprint all of a sudden gets smaller. If I'm able to move something on a pipeline versus a truck or a rail car, well then there you go. I've reduced my my carbon footprint. So it's almost like if commercial real estate, we're at ADISA, everyone understands that. Back when everyone was developing, looking for those LEED certifications, if you have an old building versus a new building, and you have a newer building that's, say, LEED certified, it may have lower operating expenses to run. So if I've got lower operating expenses, I can increase my, my funds from operations, and that's more cash flow to the investor if I have a more efficient operations. So we see that in multiple industries. Another example is the banking industry, Y2K. You had all these small banks merging with these larger banks to scale and operational efficiency. And we're seeing that again in the energy space. We're seeing smaller companies merging with larger companies, and they're trying to increase their scale. Because the The way natural gas and oil is developed today is you need scale. If you don't have scale, you're not going to be able to play in shale. That's another little joke that we have. It's one little letter. It's the letter C between shale and scale. But if operators can scale their operations efficiently, well, you can lower the overall cost to develop these projects, which will lower your carbon footprint.
Size does matter. Got it.
Yeah.
So natural gas is the greenest of the fossil fuels, but it's still a fossil fuel. Can you compare and contrast natural gas with crude oil?
Sure. Natural gas is one of those hydrocarbons which you can burn in your kitchen without any problems, right? I mean, your natural gas stove, you can burn it indoors, you have a fan. You can't do that with coal. You can't do that with crude oil. You will not do that with diesel. It's going to make a mess. But between coal and natural gas, there is some bifurcation between the two markets. Like right now, we've got oil probably about $85, $90 a barrel in the Permian Basin here in the United States. And you have associated gas production. In that basin, gas is a byproduct. Gas has traded negative. And that is because the main driver in that basin is oil. Where we operate, and a lot of the other public majors operate, is in the Marcellus Basin. And so gas is the primary driver there. But when you look at the two commodities, you're going to have both fossil fuels used in this EV evolution, like I said before. It's not necessarily a revolution, but it's an evolution. You're going to have to use all tools possible. And so the other difference between the two commodities is that when you're looking at crude oil on a decline curve versus natural gas on a decline curve. And the decline curves are important. That's your reserves, right?
Yep.
That's how much you have under the ground. And the way oil declines when it comes out of the ground is much sharper than natural gas. Oil will decline probably over 2 years sharply. After 2 years, you'll have less than 50% of your reserves. So if you're investing in oil, you have to be able to catch the right price cycle of commodity pricing. With oil up here on the $90 a barrel, $85 to $90 a barrel, that will probably drop back down to revert to their mean, right? Well, if it drops back down to the 65, 70 level, and it costs you, it's like buying real estate at the top of the market,
sure.
Right? Everything was good. You did all the right due diligence. The engineering is right. The cost is right. But the price moved against you. You probably have a 2-year margin of safety with oil. Gas, you probably have a 6-year margin of safety. And so because of the shallower decline, your decline cycle gives you a margin of safety much wider than oil.
Makes sense.
Yeah, the smart investor, and which I think our industry is starting to figure out, is that you want to pair a gas with the oil. So you can cover, say, the weakness of a sharp decline of oil with the long decline of natural gas. So everyone's using their strength to cover another weakness. And I think that's, from an investing standpoint, certainly we've seen that trend probably in the last 5 years or so.
So then I'm glad you brought that up. When is the right time to be investing in natural gas?
So the right time to be investing in natural gas is more of a cycle.
Okay.
You want to go in and average in every year. Several of my peers in our space, we have one commonality. Our investors repeat year in and year out. You're receiving a tax benefit.
Sure. I
haven't even touched on that, but if you're going to do an oil program or a gas program, you're going to receive a deduction against your current income. It's about a 75% deduction. So if you invest $100,000, you're going to get a 75% deduction in year one, and you're only going to be taxed on $25,000. But when I look at my peers in the space as a sponsor, our investors invest each and every year. So when you invest each and every year, you invest into a cycle. And I think the advisors that we work with have trained their investors that this is a 5-year investment. In other words, you have to average in over the next 5 years. What that will do is, if I am all on oil, that will continue to cover my margin of safety of oil. If I'm in gas, same thing. But when you combine the two, you're getting a more efficient frontier if you put your CFA hat on for a second.
Sure.
Yeah, so it's now. It's where prices are low because we know prices will cycle back up higher here shortly.
Thank you. And you're right. People use dollar cost averaging in their 401ks. They dollar cost average into stock positions that they really care about on companies. So it makes perfect sense that can also apply to the energy markets. Advisors are trying to evaluate which company versus another company, maybe which geography versus another geography. Can you break that down, how
Sure.
advisors can kind of pick?
Yeah, I mean, it's a good little wrap up to kind of summarize everything that we've talked through. If you were to take a piece of paper, like a cocktail napkin, and you write the word growth, GROWTH. This is an old trick from an old colleague of mine that it's just a good way to have a conversation. If you write down and you take a look at the acronym growth, each letter will represent, say, one section of the industry. And G is really simple. You can look at the geography, the geology. Where is this operator? Are they in the geology? Are they shallow? Are they deep shale? What is the bias? Is it a gas bias versus an oil bias? But that's a really simple part of the G, because if we're operating in a geography in, say, Western Pennsylvania versus Texas versus Colorado, your models, just like real estate, will be similar, but they'll be different. They'll be focused in on the inherent advantages and the rules in that basin. So sometimes you don't want to compare a piece of real estate here today we're in downtown Chicago versus a piece of real estate in, let's go back to Atlanta and, Brookhaven. Mm-hmm. Both different types of real estate. They're just two different places, and you're going to evaluate it differently. So that's the G. The R, that's more of the ratio of the oil versus gas. Oftentimes you'll have an oil operator that might have a percentage of gas that's going to come up with the oil. The gas drives the oil to the surface. The oil rides on top of the gas. You're going to have more gas, more oil, and then the third thing you get is water, which is an expense. But what are their ratios and how are they handling their byproducts? So that's the R side of it.
Got it.
The letter O obviously could stand for oil. It also stands for operator. Is this company an operator, or are they an asset manager? So there are some companies out there that aggregate funds and they deploy capital as non-operators with the big major companies. For us, we actually work with the major companies developing their wells. So we're more of a hands-on, and there's companies in our space that are hands-on operators. But that's going to be different from a non-operator, a non-op, or more of an asset manager. The letter W, the first one that comes out in my mind is, why is that sponsor here? Like, why are you here? Are you here to grow and scale your operations? Are you here because you want to offload some of your old assets? Like, why are you here, right? But that also stands for well count. Like, how many wells are you developing? Where are they? Where's your efficiency on the wells? And that's real simple. And then T is a timeline. Like, what's my expectation as an investor? What's my expectation of the wells? How long will they last? Some are longer than the others. So that's T. And then H is hedging. Some companies will hedge. That's to be able to outperform the current local pricing. And are those hedged? Are they forced or are they operational? Forced might be from if I have a bank and I borrowed money from them, they're going to want their money back. So they're going to say, hey, hedge your production at X price because we want our money back, and then you can pay your investors. So that's kind of crucial. If you have hedges, are they on for the bank or are they on for the investors?
That's a great acronym, walking us through all those details. And I like how the W there had a double meaning. Why are you here, and what's the well count?
Yeah.
Because that well count gives you diversification inside that drilling program to fit the commodity. Well, Woody, wealth of knowledge. Thank you for walking us through the current market, the drivers, kind of the political environment, but also how to invest in natural gas and some of the factors to consider. I mean, great conversation. Really appreciate your time.
Greg, thank you. Thanks for having me. It's good to be here.
And thank you all for listening. For more content like this, please visit adisa.org.